Alright, let's get started, guys. Unfortunately, I wasn't feeling well this weekend, so I couldn't do those offline lectures. I'm gonna do those hopefully this weekend, but I want to get started on futures contracts. A futures contract is an forward contract that is standardized and traded on an exchange. A forward contract is a contract to enter into a certain transaction sometime in the future, but the price of the transaction is determined at the time contract is created. Example, I want to buy 1 million British pounds by paying in dollars on February 27, 2024. But we will determine what the exchange rate should be right now. And the way the exchange rate, the way the fair forward rate should be depends on obviously the current rate, length of the forward contract, and the interest rates for pound and GBP, pound and USD. In general, when you have a forward contract, the interest rate for the currency in which prices are denominated is called the discount rate, and the yield of the asset is called the asset yield. You know, if we're buying pounds by paying US dollar interest rate is going to be the discount rate, and the asset that we're buying or selling is the British pound, so British pound interest rate will be asset yield. Sometimes, you know, if you're doing a forward contract on a stock, for example, The dividend yield is going to be the asset yield uh, for asset yield. For commodities, there is something called convenience yield, the transaction costs, storage costs, and that sort of stuff uh, will be taken into account. We're going to look at the commodity kind of stuff later, but for now, let's concentrate on forward contracts. Forward price in general, it's going to be what we're going to call spot price times 1 plus the discount rate divided by 1 plus asset yield. I can make an arbitrage argument for that, but you probably have seen it before. I mean, I'll do an example. Suppose we are talking about 1 year GBP pound or GBP USD forward contract. Right now, spot is, let me go to here, 120.53, which means value of 10,000 GBP is equal to 12,053. Okay. Or 1 pound is equal to 1.2053 USD. Current 1 year USD rate, discount rate is, let's find out. I'm going to find this from the yield curve. We can find it in other places too. It's going to be easier to get. Let me see, 5.104. And current 1 year pound rate is, let's go back. I have a similar curve for treasury bonds of the UK government, which are called gilts instead of bonds. In German, they're called Bunds, which is different stuff, 4.114. Hence, according to the formula above, the 1 year forward should be 1.2054 times 1 plus the discount rate, which is the US rate, divided by the pound rate. Okay. So the country with the higher interest rate will have its currency trading at a forward discount, which means value at the forward rate is going to be lower compared to value now. The country with the lower interest rate, it's going to be trading at a premium, forward premium. Currently, pound is trading at 120.53, but in the forward market, 121.59. So that's the forward premium. Okay. let's suppose market said forwards 121. Okay. Let's see if we can make an arbitrage argument. Okay. I can purchase pounds forwards at 121. 1,000,000 pounds. Let me make it 10,000 pounds at 121 per pound, which means by paying